Hi, I'm Pattu from freefincal. Today let's talk about a basic question. Why does the rupee fluctuate in value against the US dollar? Now, the forex market should be thought of as similar to the equity market, the bond market, the oil market, the commodity market, etc. So just like in the equity market, there's a lot of speculation. There's also a similar amount of speculation in the forex market as well. So, for example, in the equity market, you have the March 2020 crash. That the crash occurred for about 2 weeks, and then it recovered. Although the economy did not recover, the participants in the equity market believed that the economy will recover, and they speculated on that and put money into it, and therefore the market recovered. So there's a lot of speculation in the forex market as well, and that's essentially that's one of the primary factors for governing what happens there. So there are two things that happens in the forex market. So the actual demand for dollars versus the supply for dollars, and the expected or the speculated demand versus supply for dollars. These two factors is what governs the USD INR rates. Of course, on a day-to-day basis, it's the speculation that is the major driving factor. It's the same thing happens in debt funds as well. For example, in debt funds, we are taught that when interest rates increases, then the NAV of the existing funds will fall and so on. But the fact is that there's so much speculation that if the bond market participants feels that the interest rate is going to increase, then they will take action much before that. So it doesn't happen after the event actually pans out. So now there are two factors here, and we are concerned about the USD INR rate primarily because that's where all the most of our financial transaction outflows happen in that currency. So if there is an actual or expected inflow of foreign capital, then the rupee will become stronger. That is, the rupees per USD rate will decrease. So when there are more of foreign investments into our country in the debt market or equity market, and there are higher exports, this will happen. And the opposite of that is when there is an actual or expected outflow of dollars, then the rupee will become weak. That is, the rupee per USD rate will increase. So when there are FII redemptions or Indians investing abroad, for example, when we invest in Parak Parik FlexiCap and so on, or buy some international ETF, or there are higher imports, we increase the imports of gold, or the crude oil prices increase, or the amount of crude oil we import increases, then the rupee will become weaker. And of course, when the oil or the fuel prices increase, the inflation will also correspondingly increase. So it is this net impact of the actual and expected dollar supply versus dollar demand that determines the INR USD rate on a daily basis. Now, some of the common examples are, if there are companies which are exporting goods and services like IT services, like IT companies, then they will benefit if the rupee falls. But at the same time, if the rupee becomes weaker, then companies that depend on foreign capital or foreign raw materials, they will suffer, or vice versa. Now, if you look at our country, we are a net importer because in June 2021, the Indian imports were valued at about $41 billion, and the exports were valued at only $32 billion. So it has got a what is known as a trade deficit. It's a net importer. If you look at the historical values of this exports minus imports, what is known as the trade balance, since the economy opened up and after that gradually the trade balance has become more and more negative, it had shot up suddenly to above zero just before the pandemic, but then the pandemic brought things back to the same situation again, and we have become a net importer. So becoming as long as the our exports are strong and they keep increasing, the rupee depreciation will not be so much. Now you can get historical USD INR rates from gold.org. You get the gold INR price and gold USD price from here. you can convert the, you can use this to get the currency rate. So if you look at, this is the historical chart, and on 2nd January 1979, 1 USD was 7.9 and today it's about 75 rupees. This looks like a bad deal because you see that the chart is, the price is moving up. So it feels as if the rupee is becoming weaker, but that's not true. You see here that in the last couple of decades, you can see the rupee is fighting against the dollar. You can see that there is the rupee became stronger here, then it moved up. Then there are fluctuations. The fluctuations have become so much more. Earlier it was kind of a stepwise increase, but now the rupee is fighting the dollar much more efficiently. And if you look at the 10-year rolling returns, you can see how much it was in the 90s. And you can see here it was 10%. That is the exchange rate, or the rupee became weaker over 10 years by 10%. Whereas now you can see that it has become, the rupee has become so much more stronger. The USD INR rate, the return over 10 years, that is the change over 10 years, has become so much lower. It's basically like 1 or 2% over 10 years or something like that, or even less than that. And so that's a very good sign that the rupee is becoming weaker. So you don't want to bet on the rupee too much. I should say, you don't want to bet against the rupee on the rupee becoming too weaker and so on. So that's about it.